Hello, my name is Cameron Stewart, CFA from Rational Investing. This episode, we are going to look at how to read an income statement. The single most important financial statement that's out there, certainly the one that's quoted all the time. Let's figure out how to read it. What are some key takeaways I've used in my 20 years of financial experience to read annual reports? Behind me is the Coca-Cola annual report, the most recent 10K. 10K is simply the annual filing versus the Q, which is done quarterly. Behind me is their income statement. Let's walk through each line item, figure out what it means, and kind of rank them in terms of level of importance. Other detail to look at. Every company is going to vary. There's no set template for what they need to disclose in a 10K. So some companies will give you a whole lot more information than others. Other companies like Coca-Cola give you a very abbreviated statement, and they put a lot of it in the MD&A, the Management Discussion and Analysis section that you need to continue reading in the annual report. But here we go. Net operating revenues. Why does it say net? It's net of things like sales tax. So there's gross revenue, which includes sales tax. The companies can't keep that. Obviously, they have to give that to the government. So they express revenue net of sales tax, net of chargebacks on credit cards, net of returned items, net of damaged revenue or other kind of lost revenue. So that's why it says net. Typically, you'll see companies break this out a bit more, give you a little more detail, maybe product sales, service sales, geographically. They can represent it in a different way. But here, Coca-Cola gives you one line, boom. Here is top line revenue for the entire business, $28.655 billion. It's actually a monster number, huge. Congrats to those guys. For 2021 in US dollars. When you read a P&L, I would also suggest reading it on a per unit basis. Many companies don't do it. They do it later in the MD&A, but you want to find a base unit of an enterprise that you can relate their growth rate to. At Coca-Cola, it would be liters or volume of syrup that they're dispensing. If it's a manufacturing company like Coca-Cola, could be per cans if that was their unit, or a software company might be active users. You want to be able to relate the material to a quantifiable sales product or sales service. Something helps give relevancy to this $28 billion number. If you break it down on a per ounce volume number, it might make a little bit more sense, and you can use that when you judge how the business is performing going forward. But let's keep going. So the next line that's always after revenue is cost of goods sold or cost of service provided. Basically, the variable cost derived from the revenue, that derives revenue. So what does this mean? This means if the unit is sold, that's a variable cost. The more revenue I book, the more units I have sold. That's a variable cost. It goes in the cost of goods sold. So all your aluminum cans, for example, the actual raw ingredients for the syrup, any labor that's in the manufacturing facility that cranks out and makes that can or the syrup, all those costs vary with the volume of output of the business and vary with the volume of revenue that the company generates. The more products they sold, the more revenue they're going to get, the more this number goes. So you typically will look at this as a margin, not necessarily the individual dollar. In here is also depreciation. So they're able to take the manufacturing assets that they own for many, many years, and they're able to depreciate them. That simply means instead of expensing it all in one, like let's say they spent $10 billion building a giant Coca-Cola factory that's going to run for the next 20 years. Well, they're not going to expense $10 billion once in the P&L. It would destroy their profitability. So what do? Well, they put that $10 billion on the balance sheet as an asset, and over time they depreciate that over, say, 25 years, 20 years, the useful life of that asset. And that 1/20th of the $10 billion cost is in this number as part of a variable cost because it was used to generate the sales product. So there's typically depreciation in here. So it's not all cash is what I'm trying to say. If I subtract these two, I get gross profit. Gross profit is generally the third line. It's basically the profit after variable cost. I paid the manufacturing people. I paid the service provider. If I'm an SaaS company, I paid my engineers for developing, for operating the software. What's left after the variable cost, after the per unit production value? And that's your gross profit. And like I said before, you typically want to express this as a percentage of revenue. So you'll take gross profit, divide by revenue, and you get your gross profit margin. That is generally what people look at when they look at this line. The dollar amount is nice, but really the dollar amount will vary with revenue, so you want to look at this as a percentage. If it's like, so 23 divided by 38, that's 60%. So I would say their gross margin is 60%. That means for every dollar of revenue they generate, they keep 60% of that as a gross margin. And that 60% is generally fairly consistent over time. And if you're building a model, you're looking to forecast the business and you're growing revenue, you're going to want to take 60% of revenue to grow gross profit. That's generally how you look at it. They try to hold a margin constant for a long, long time. Only by production efficiencies can they, well, there's other ways, but mostly production efficiencies can they increase the gross margin over time. So for example, new technology using automation instead of human labor will generally give them a boost to the gross margin, but it's very difficult to get, and you don't want to rely on that as a means of growing earnings. The next one here is selling, general, and administrative costs, SG&A. SG&A. That is one giant bucket. I really wish they would break that out. Most companies do. Coca-Cola, Apple, some of the beasts, they simply don't. They're like, here's one number. You can read the detail if you want it. But in there is rent for all the non-operating buildings, the distribution they would be up in distribution centers would be in COGS. The corporate offices, the sales team salary, the executive salaries, accounting, legal, any lawsuit settlements are in there. Any insurance that they pay is there. Legal fees, all kinds of stock-based comp is in there. Research and development is in that numbers. Basically, anything that's not a variable cost is in that number. And I really wish they would break it out. It's $12 billion. It's a big number. It's half of their gross profits. It's a really big number, and they should break that if they don't. Because they're Coca-Cola, they can kind of do what they want. But generally, that number is what they call fixed costs, meaning my legal bill for the year or my insurance for workers' comp insurance or my rent is fixed, meaning it doesn't vary with production. It doesn't mean it's constant. It can grow if I expand my head count, hire more people, it's going to grow. Rent always typically grows with inflation. Lawyers raise their rates. Like, it's going to grow. But the point is, it's fixed because it's not linked to revenue in the way that cost of goods sold is linked to revenue. So you generally have a different growth rate here versus here. And this is where you get your scalability. That's what people, when they talk about businesses scaling, the gross margin, the COGS is generally a percent of revenue, and that's fixed. We said 60% here. So if you grow revenue, and this cost is 60% of revenue, so this number grows in line with revenue. So how do you scale profit if costs grow in line with revenue? It's here. This number will typically grow with inflation, say 3 to 5% annually, depending upon where the business is in their growth curve. But in general, this will stay much more constant, and this will grow. So your profit scales here by this number growing slower than this number. And you can see that this is fairly constant here over 2 years, 12.1, 12.1. But this here, gross profit is growing 22.6 billion, 23.2 billion. So this is growing on constant fixed costs, so their margins, the profit margin expanding. All right. Then after SG&A, there's typically other operating charges. This could be one-time charges like a lawsuit, a legal settlement. Could be if they shut down operations on something. It could be not quite shut down. Other operating costs that don't belong in SG&A, they're generally pretty small. You can see 800 million versus 12 billion. It's a small number. That brings us to operating income. Right, so operating income is generally what you want to look at as a steady state number. If you're on to forecast the business out long term, the noise is what's called below the line. This is below the line, that's above the line. If you've ever heard someone refer to earnings above the line, operating income is generally the line they're speaking of. And operating income is generally is the income derived from the core business. Below that are going to be things like interest costs, if they close an operation, if they make acquisitions, other things that aren't exactly tied to running the Coca-Cola branded business. So next we've got interest income. That's cash they make from the cash they have in the bank. Interest expense, that's the interest they pay on their debt. Interest only, not principal payment. Equity income is the changing of the equity value for business investments they have made that they don't own the majority of the business. For example, if Coca-Cola buys Monster Beverage, let's just say, and Coca-Cola owns 10% of Monster, they can't control the business, so they're not going to consolidate the entire business. They're simply going to report it as an equity value and change that equity value every year depending upon where they think the value is. And so this is a non-cash income. Other income and expenses, kind of like basically an other bucket. After that, you get income before income tax, taxes, and consolidated net income. I think those are pretty straightforward. This income tax, by the way, is not a cash tax. This is a book tax. What they give to the government as far as filing for profit, it's not the actual taxes paid. That's actually a different set of financials. Companies do it all the time. They have financials they give to investors, and they have financials they give to the government. They're two separate things, and there's generally a carrying value of tax liability on the books that bridges the two financials. Net income for attributable non-controlling interest. Here, Coca-Cola has assets that they own and consolidated. They don't own 100% of. This is the earnings for those shareholders that still own the assets that Coca-Cola is consolidating. Back to our Monster Beverage example, if Coca-Cola bought 90% of Monster, there would be 10% of the original Monster Beverage owners out there. This line here for non-controlling interest would be the 10% Monster Beverage owners' pro rata share of the net income of Coca-Cola. Next, you have the basic net income per share. That simply is taking net income attributable to common stockholders divided by the shares outstanding. Next, you've got diluted income per share. Now, what is diluted versus basic? Diluted says if I have debt that is convertible into common stock, or I have written warrants out there for people to buy common stock, or I have options that are out there that could be exercised. It takes all of that combined, assumes it all gets exercised, that all the stipulations in the documents for when and how those shares are exercisable, it assumes it all happens. The total number of shares that could possibly be outstanding at any time is the fully diluted number. And I encourage you to use that number, especially when we're talking about these disruptive companies out there. They love giving convertible debt out. They love giving stock options and grants and warrants, all of which, if effective, is massively diluted to you. So you as an equity owner, you want to make sure you're using fully diluted net income. That's how you read a P&L. The bottom of the P&L is typically the weighted average share count and weighted average diluted share count. These are the numbers I use when I look at stock. You can also use the very first page of the 10K. It'll say shares outstanding. That is as of filing date at the end of the fiscal year versus in the income statement, it's a weighted average for the year in case they bought back shares or they issued shares. It's a weighted average versus a point in time estimate at the beginning. That's how you read a P&L. Not all of this, P&L, income statement, same term, by the way. Not all of this is cash. That's why it's important to read a cash flow statement, which takes this along with the balance sheet and bridges the two to give you how much cash money the company made. Thank you for your time. Bye-bye.